Traders, we're going to discuss 3 different scenarios. Green light, that means full speed ahead, trade aggressive. Yellow, want to be a little bit cautious about what I'm seeing in the market. Red, I'm not trading at all. And we'll go to the charts, look at 10-year yields, Nasdaq, S&P, gold, Bitcoin, and Ethereum. Let me take you to this week's NinjaTrader Charting Edge. Pulled up the E-mini S&P here on a daily for the 3rd week in a row. Same old on the charts, but I added 2 moving averages this week. 20 period, 3 standard deviation Bollinger Bands. Red is the 10-day simple moving average, all simple moving averages. 20-day, 50-day in the green, 100-day in this light purple color. Now, why did I add the 50 and 100-day moving averages? What do I say every week? What have I been saying in the E-mini S&P the last few weeks? When the mouth of that Bollinger Band is open and the market's going in the direction of the top or the bottom, as in this case right now we're going in the direction of the bottom Bollinger Band, I don't step in front of that direction. So I added the 50 and 100-day moving averages because I want to see if this trend is breaking down to the longer-term moving averages and we could potentially accelerate to the downside. So I like to add moving averages for confirmation. And what you've seen here for a period of time is us hugging above the 50-day moving average. We all know how strong the trend has been. And now we hit that 100-day and bounced off it, and we're looking to come right back to it as we record here today. So what's interesting to me is this, is if we start to violate the 100-day moving average and the mouth of that Bollinger Band is open, you have not seen that in some time. Not on this chart at all. It's been a while. The trend could really accelerate to the downside, and I would only be looking at shorts. One, because the mouth of the Bollinger Band is open. We're below my 10-day moving average, which you know I like. We had really a few days last week where it was trying to hold above it and right back down below it this week. But if we start to go below these longer-term moving averages, that could tell me that we could really accelerate to the downside, and I'd only be looking at one side until when the Bollinger Bands start to come back in and we start to go back up and get back above the 10-day moving average, which will be the one I'm looking at a lot at that point, getting way ahead of ourselves. We don't know if that will happen, but I like to use these moving averages as a guideline, and right now I've added them to see if this trend could accelerate to the downside or if we potentially hold and that mouth starts to close. So that's what I'm looking at right now in the E-mini S&P. At the beginning of the episode, I talked about red light, yellow light, and green light. I put this tweet out the other day. Divergence in the indices, yields popping to recent highs, gold and crypto weakening, hard market for equities and crypto to pull out right here. Tells me to stay away from the long side, red light, right now, as we could see capitulation type moves coming. Let me take you to the E-mini Nasdaq. Here we are at the E-mini Nasdaq. Daily chart, same as I covered in the E-mini S&P. Now, let's look at the Nasdaq here. Mouth is open on the Bollinger Bands, breaking down below the 50, 10, and 20-day moving averages. Very similar to what we saw in the S&P, sitting just above the 100-day moving average. Very similar to what we're seeing in the S&P. Mouth of the Bollinger Bands are open. In both markets right now, we are really in this yellow light scenario where it's caution being long. I still think that the bull trends are intact, but it's indicating to me caution because if we fail to hold this 100-day moving average and we start hugging that bottom Bollinger Band, that would be red light for long, green light for short. So this is why I like that type of scenario for me, because I know that if I get any intraday setups in the Nasdaq, it's yellow, it's caution. Be on alert for a possible breakdown of the 100-day moving average in the Nasdaq and the S&P, because then it would be red light long, green light short. Let's go quickly back to the E-mini S&P. Just wanted to pull this back up to show you how close and similar they look. So I know S&P right now is yellow, chopping around moving averages, but the Bollinger Bands are open and the 100-day moving average is close. We've not broken down below it in some time. If it starts to get hit below it, that would be red light long, green light short. Let's now go and look at the micro 10-year yields. In the tweet, I talked about how the yields are now popping. Here we are with the micro 10-year yield futures, which I've been pulling up at symbol 10Y. And what I'm seeing here is also something I'm keeping a close eye on for confirmation for the E-mini S&P and E-mini Nasdaq. We talked about how the E-mini S&P and Nasdaq are both in neutral right now, sitting around those daily moving averages on the cusp of possibly breaking down below the 100-day and hugging that bottom Bollinger Band. And then I go to look at what the micro 10-year yield futures are doing, and they're hugging that top Bollinger Band, really getting an uptick here. And on the macro side of things, as this market goes up, that will potentially hurt equity. So traditionally, a higher yield will be a negative impact on equities. So what does that indicate to me as an equity trader? If I see this in my scenario right now being very bullish, so this is green light long, what happens if the S&P and Nasdaq get below the 100-day moving average and start hugging down below on the bottom Bollinger Band? Then you'd have confirmation from the 10-year yields going up, and then you'd have a green light for the futures in the S&P and Nasdaq going down. This is something that's very important for us to be watching as traders, because this is an additional green light, a very bright green light, to be short equities if this look continues on the 10-year micro yields. Next, let's take a look at gold. I've said this a bunch of times before on Twitter, on my podcast. Gold is not a hedge against equities. So many people say, well, I'm balanced. I have equities and I have some gold. If the stock market goes down, maybe I'll have some gold to offset that. In my experience, I've said this so many times, trade gold for what it is. If you're buying gold as a reason to hedge against equities, just look at what the market's done over the past several years. Go back to 2008, pull up any chart, and you will see that gold is really not a hedge against equities going down, because look at where we are right here. Boy, this looks a lot like the S&P and the Nasdaq now, doesn't it? Except it's well below the 100-day. It's below the 50-day, the 20-day, and the 10-day, hugging that bottom Bollinger Band, giving me what? A green light short. And what's interesting about this and why I wanted to talk about it is because a lot of the breaks, a lot of the sell-offs we've seen in the market will have all of these other markets that you will use as an opposite correlation. I don't think gold is a good opposite correlation for equities. I've already said that, but it's something that I think that traders will watch. If all of a sudden this starts going down with equities, the people that have gold to offset their equity positions, all of a sudden now you could see a steeper decline in gold, and all of a sudden you have selling across the board. I've seen this many times before. So I keep a very close eye on gold to say if that starts breaking down with equities, that could even be another bright green light to equities on the short side. Next, let's take a look at Bitcoin. Notice something similar here with the Bitcoin chart. What did I say with gold? Gold, I don't believe it's a hedge against equities. Some people do. But if you own gold and equities and they start going down together, you could see selling accelerate across the board. Very similar with Bitcoin, right? All of a sudden, Bitcoin now hugging on that 100-day moving average below the 10, 20, and 50-day moving averages. If it starts hugging that bottom Bollinger Band, along with gold, along with Nasdaq, along with S&P, with the treasury yields going up, that could be a really bright green light to accelerate to the downside. Sometimes when we see selling start in one market, especially the equities market, which is really the most important market, that and the bond market, it can start to spill over to everything. If we start to see Bitcoin going down with gold, with S&P, with Nasdaq, I think that could be another emphasis on the green light acceleration to the short side, where I would step away from being long anything. We're not there yet, but it's something I'm keeping an eye on. Let's take a look at Ethereum. Boy, these charts are looking more and more alike, aren't they? Here we are with Ethereum sitting just above the 100-day moving average, but below the 10, 20, and 50-day moving averages, with the mouth of that Bollinger Band opening up. A lot of yellows we've seen so far, on the cusp of becoming red light long, green light short. If Ethereum starts to break down below the 100-day moving average, and we see all these other markets that we talked about today start to have that same look, listen, in my experience, when I see a lot of the major asset classes that we look at all start to have a very similar pattern, especially to the downside, and we start breaking down, that could accelerate selling across the board. That's why I like red light, yellow light, green light, because I see a lot of neutral right now to where it could turn red light long, green light short. And I don't want to own any of these assets because I am seeing everything work together. You don't see that too often, but when that does happen, you've got to take note. Treasury yields are moving now, folks. You heard me talk about them today in this show. Make sure you pull up the 2YY, 5YY, 10Y, and 30Y micro treasury yield futures. And to learn more, go to cmegroup.com. Today I talked about red light, yellow light, and green light. I put this tweet out the other day. As a new trader, I traded my best when my back was against the wall, but when things were going well, I'd lay off. That's a poor mindset. I had to learn to be a taker when the market's giving and lay off when the market is taking. This is integral to go from a losing trader to a winning trader. This is part of the reason why I put in red light, yellow light, and green light. I needed to know when things were good on the green light to keep trading, keep pushing. If I'm winning, keep taking. If it's yellow, trade smaller or not at all. Don't give a ton to the market. And when it's red light, don't go in the market in this direction. Wait for a setup that is green light. But many of us make the mistake of when things aren't working or we go to fade a potential trend and we push harder then. But when things are going well, we lay off because we're happy to be winners. Making money in trading is about seizing moments, taking advantage of moments when things are working and you're making money. And when they're yellow or red, you lay off. You know when to trade big, you know when to trade small, and you know when not to trade. If you enjoyed today's show, smash that like button and give us the thumbs up. If you didn't, give us the thumbs down and put your comments down below. Never miss an episode of Develop Your Edge. Hit that subscribe button. And if you want to leave me a message, you can contact me on Twitter at Anthony Crudele. And don't forget to check out Instagram at Anthony C. Crudele. That's a wrap for today. See you next week.